In this week's video, we'll review the latest charts and data to help us answer the question, is a triple economic boom bull market underway? We'll be moving quickly, so feel free to use the pause button on your video player. In this segment of the video, we'll expand on some of the margin of safety concepts that we covered in last week's video. The chart on your screen was originally covered on September 1st. It's dated August 30th. It's NYSE new highs minus new lows. Numerous times last year, including on September 1st, we said that we really would like to see market breadth improve. And in last week's illustration, we used two different ETFs, RSP, the equal weight S&P 500, and SPY, the standard weight S&P 500. To recap, both ETFs, both indexes, own the exact same 500 stocks. The only difference is the way they're weighted. RSP, they're equally weighted. SPY, capitalization weighted, meaning large companies like Microsoft, Apple, Amazon, and NVIDIA carry a heavier weight in SPY relative to RSP. And just a few short weeks ago, on October 27th, the equal-weighted S&P index was down year-to-date 5.46%, highlighting that at the end of October, the S&P 500 index and SPY, the gains were primarily driven by 7 stocks known as the Magnificent Seven. When we looked at all 500 stocks, including the Magnificent Seven, and weighted them equally, the year-to-date return was approximately a loss of 6% on October 27th. Another concern in late October, equal-weighted index needed to prove something, and it needed to prove something quickly because it had just broken down out of a 9-month consolidation box, and we had the 200-day moving average in red here rolling over in a concerning manner. And remember, we're covering all this because it ties into the concept that weak market breadth year-to-date in 2023, really during the entire year, was a concerning issue, something that didn't really align with the bullish case. And all of this is relevant because market breadth speaks to the margin of safety or the probability that the S&P 500 index is going to be able to carry higher into the weeks, months, and years ahead. And the fact that the Magnificent Seven were doing quite well year-to-date at the end of October, and the equal-weighted S&P 500, or the other 493 stocks, were not doing particularly well, it told us that market breadth was still concerning, and it was still weak, and it still needed to improve. And since breadth speaks to the number of stocks participating in a rally, it's also noteworthy it wasn't just the equal-weighted S&P 500 index at the end of October. The broad NYSE Composite Index, October 27th, year-to-date return, negative, down 3.24%, also breaking out of a multiple-week consolidation box. The same could be said for the S&P 600 Small Cap Index. Just a few short weeks ago, October 27th, it was down 7.67% year-to-date. This figure here, and this figure here told us that not only have we not seen improvement in market breadth, if anything, it was getting worse. And if this trend, and this trend continued, we could be looking at back-to-back annual losses after the 2022 bear market. And if that's the case, SPY and the Magnificent Seven are becoming more vulnerable by the day. And in the first half of 2023, S&P 500 new highs minus new lows still had not cleared some very important hurdles relative to margin of safety. For example, hadn't cleared this level from January 1st, 2001, hadn't cleared this level here from 2002, hadn't cleared this level here. This level was hit during a counter-trend rally in May of 2008. And when breadth was unable to clear this hurdle in 2008 and in 2002, that was not a good sign. The additional loss, in this case over 40%, in this case almost 53%. These important hurdles are tied directly to market breadth data. We also have bull-bear reference points that are tied to weekly RSI, which speaks to broad market momentum. And in 2022, during counter-trend rallies, we were unable to clear these important levels. The same was true early in 2023. During the dot-com bust bear market, there's a strong counter-trend rally in 2001 that carries into early 2002. RSI gets to this level here, right around 55, and the rally fails. Something very similar in the financial crisis bear market. Market falls from point A to point B, rallies into approximately mid-May of 2008, comes up near the same levels, 54 and change, and the rally fails. And in each case, throwing the margin of safety principle out the window was painful. The additional loss from this point here to this point here in the S&P 500 after that failed rally, approximately 34%. The additional loss after this failed rally here, almost 53% in the financial crisis bear market. And in the 2023 case, we really don't clear these levels in a convincing manner until June 2nd of 2023. Very similar concepts. Now we're using weekly RSI for the NASDAQ Composite Index. It's a strong counter-trend move from point A to point B in this case. Strong counter-trend move from point A here to point B. Both rallies fail, with RSI hovering somewhere around 56 or 57 on the weekly chart. And then the bear market resumed and the additional losses, painful. Almost 46% in the 2002 case, almost 50% in the 2008 case. We did not clear these levels in the first 4.5 months of 2023. The first week that we got a convincing weekly close above those levels, not until May 19th, 2023. Nothing magical about any of this. It just speaks to a higher probability that this is a lasting low here in 2002 relative to a counter-trend rally that's going to be followed by additional and painful and costly drawdowns. This is based on weekly RSI in the NASDAQ. If we go back to the breadth data, these lines here were not cleared until June 16th. And this level here from 2002 wasn't cleared until December 13th. And as we covered last week, does taking a margin of safety approach mean you will miss out on the opportunity for additional gains? Way to answer that question, December 13th, we clear the blue line. Cleared the same blue line on June 6, 2003. Cleared the same blue line on October 14th, 2009. What happened next in the stock market? In the historical cases, additional gains did follow, and they were satisfying. Average gain in the S&P 500, almost 56%. NASDAQ 100, 5 years out, almost 92%. And that's walking forward from June 6, 2003, October 14, 2009. They're very similar to what we saw on December 13th of 2023. As we walk through the charts month by month as it happened from calendar year 2023, we want to do so in the context of the elements of our base case. It's a monthly chart of the S&P 500 dated June 14th. It was covered in the June 16th, 2023 video. It's not unusual. In fact, it's common for the S&P 500 to oscillate between periods of secular stagnation, denoted by the orange boxes, and long-term bullish trends or secular trends. And if we look at the strength of the trend, you can see in this case it starts to pick up way back in 1942. Trend is incredibly strong until early 1969 or late 1968. That's a 27-year period. After the period of secular stagnation in the orange box, between 1969 and 1974, you can see the trend deteriorates in a way that's different from the box over here, the 27-year box. The trend starts to improve in 1974, has kind of a mixed bag look in here, and then takes on the secular trend look after the breakout in 1982. This blue box lasts approximately 27 years. This blue box approximately 26 years. We've got a similar pattern during the current secular bull market. And hypothetically, if the trend lasted 26 or 27 years, we could be looking at a primary trend that lasts until 2034 or 2035. As we head into 2024, if we review the long-term charts objectively, it's very difficult to poke holes in the secular trend thesis. The charts in calendar year 2023 aligned with, rather than contradicted, the theory that good things could happen for a long period of time. How is it possible that the stock market's current trend could last until the mid-2030s? Powerful and favorable demographic trends. Early in life, under the age of 25, later in life, 75 and older, you have a tendency to consume more than you produce. The primary economic sweet spot, 35 to 54, where you have a tendency to produce more than you consume, which means you have money to save, spend, and invest. If we pair the demographics with the trends, it becomes much, much easier to follow and understand. Lower left-hand corner of your screen, baby boomers, 1964, are between 0 and 18 years old. So as we move forward in these windows, we have a large segment of the population acting as an economic drag. That changes in 1982. The youngest boomers are 18, just becoming productive in the workforce. The oldest, 36, they're in the sweet spot window between 35 and 54. And as we move in this direction, the demographics continue to improve all the way out to the year 2000, where all of the baby boomers are in the sweet spot. All of them are between 36 and 54 years old, putting them in that 35 to 54 window. And then when the oldest boomers reach 55, they start to become more of an economic drag, and we go into a long period of secular stagnation. Very, very similar situation over here in 2014. 1982, the baby boomers, 18 to 36. 2014, millennials, 18 to 33. And this is highly relevant because in 2019, the millennials overtook the baby boomers as America's largest generation. In the 1982 to 2000 secular bull market, we had what some demographers refer to as a double boom. You had the baby boom generation and the second wave, Generation Jones. We have something similar when we look at the millennials, aka Generation Y, and the generation right behind them, Generation Z. Oldest millennials in 2023, 42 years old, experienced, and they've got 27-year-old millennials behind them, the youngest millennials, and 26-year-old Generation Zers, the oldest Generation Zers, in the workforce and already productive. Much like the baby boomers walking forward from this period here, as we move from left to right on this table from 2023 all the way out to 2034, the demographics will continue to improve. They will become even more favorable. And in 2034, the oldest millennials will be 53 and the youngest millennials will be 38, which is very, very similar to the year 2000, where the youngest boomers were 36, the oldest boomers were 54. And look at the wonderful move in the stock market into the end of that window between 1995 and the year 2000. This is where the double boom really kicks in. More information is available by Googling the title on your screen. You can also visit our website and click on the demographics link. Remember when we looked at the pattern of secular trends, we said the window was still open and the demographics support that theory. Simply telling us to keep an open mind about better than expected outcomes over the next 11 to 12 years within the context of 100% normal and to be expected volatility that's going to occur between a point A and a point B that could be several years down the road. Using some simple and time-based calculations, we made the argument in June that the present-day window here is similar to this point here in early 1989, and after that, really good things happened in the S&P 500, additional good things, till the market peaked in the year 2000. And you can make a rational and logical argument that June of 2023 was similar to this period in here in the mid-1950s. In this case, the S&P 500 gained historically an additional 142% before the end of the secular trend in this window here. With numerous innovations driving productivity between 1982 and the year 2000, personal computers and spreadsheets to name two, the NASDAQ, the tech-heavy NASDAQ, and the NASDAQ 100 gained eye popping additional returns from this point here to this point here. And that segues nicely into our third major concept, which is a productivity boom driven by advances in technology. It's looking more and more and more like AI is a game changer. If we take the charts that we can see, measure, and put in a model that align with the secular trend thesis, and we couple that with present-day demographics, everybody's already been born, it's not going to change, and we add a third component to that mix, significant technological advances that enhance productivity, it's possible we're on the cusp of a triple economic boom. And it's quite possible that a productivity boom will provide some significant and game-changing offsets to legitimate and fact-based concerns about inflation and interest rates. In this segment of the video, we're going to review the charts that we covered in 2023 month by month, and we'll do so in this context. The charts that we had in front of us in January, did they tend to align with or contradict the theory of a triple economic boom? Or do they align with periods where market participants are more concerned about inflation and interest rates? Coming off of the 2022 bear market, it wasn't surprising on January 6th that the longer-term trend for the S&P 500 shown on the right side of your screen was weak. Since one of the main objectives of the CCM market model is to put our capital in harm's way when the odds are in our favor, to reduce our exposure to risk when the odds are clearly against us, it's not surprising, given what we knew about the market on January 6th over here, S&P 500, that we entered the year with roughly 85% of our assets on the sidelines. When the first day of trading kicks off in 2023, we're just a few calendar days removed from the Nasdaq's lowest low made in the 2022 bear market. Thus, our margin of safety based on the evidence on January 6th, not very favorable. But right out of the gate in 2023, tweet dated January 4th, the tape started to improve. And as a fiduciary at that point, a fiduciary that's primarily managing retirement funds, in an environment where money markets are paying over 4% in January of 2023, we always have to think about opportunity costs. So as the year evolves, you have to decide, can we prudently and realistically try to beat the return of a money market in 2023 without taking too much risk and without significantly stepping outside of the charts in front of us? Best case scenario for the stock market in 2023 is that it's a transition year from clear downtrends and bear markets back to clear uptrends and bull markets. On January 6th, the market can't decide in any definitive manner between stocks and bonds. And much like the tape, this chart that we covered in January, dated December 30th, told us to keep an open mind about better than expected outcomes. And in December 2023, it may be difficult to remember just how pessimistic market participants were a year ago or in early January 2023. With Morgan Stanley warning that U.S. profits could drop like 2008, tanking stocks, and a data-based recession forecasting model from Bloomberg pegged the odds at 100% that the U.S. economy was going to go into a recession between October of 2022 and October of 2023. And on January 6, 2023, this chart of the Nasdaq and its trend, this is the 250-day moving average here. The look of that chart on January 6th aligns with the headlines on your screen. And while the S&P was clearly in a downtrend, the outperformance of foreign stocks on January 20th told us to keep an open mind about improvement on this front in 2023 and to keep an open mind about an improvement on this front in 2023. And in a January video, we water tested the theory that stocks were about to tank due to an earnings recession. That earnings recession kicked into high gear in the second half of 2008, and if we looked at the data in Q1 of 2023, it looked a lot stronger, the economic data, relative to August of 2008. This really doesn't look anything like this. And the improvement in market action noted on January 4th, carried forward and produced numerous signals that we covered in January and February, once again telling us to keep an open mind about better than expected outcomes in 2023 despite the clear downtrends that were present on January 6th. Chart of the Dow Jones Home Construction Index, charts dated January 26th, also told us to keep an open mind about better than expected economic and interest rate outcomes in the coming months. In early February, an economic announcement threw a wet blanket on the imminent recession theory. Monthly labor data that was reported on February 3rd came in well above expectations. This still looks significantly better than anything that we saw in calendar year 2022. And the economists that had previously identified the yield curve as being helpful in economic forecasting told us not to read too much into that inverted yield curve, to possibly take it with a grain of salt. If 2023 was going to be a transition year, a successful transition year, we needed to see incremental improvement. That's what we have here. This chart we covered, it was dated February 23rd. March 2023 was marked by bank failures, throwing gasoline on the rampant calls and never-ending calls for an imminent economic recession. March 9th, the chart of the NYSE Composite somewhat in bull-bear no-man's land. March 10th, somewhat foreshadowing what we were going to see in late October. And from a transition perspective, 2023 was also a year where we were trying to determine, did the massive global stimulus and the arguably excessive Fed policies, was all of that going to harm the markets and economy for several years? Or was the secular bull market going to get back on track? Headline dated March 23rd, 2023. And while it may seem easy to forget, on March 23rd, 2023, the NASDAQ was still clearly in a downtrend. But from a good news perspective, and from a longer-term perspective, we looked at this setup here in March. Historically, it told us to keep an open mind about the secular trend resuming in 2023 or 2024. Chart dated March 30th, 2023. And while all the money printing and the excessive policies from the central banks may have caused some extremely odd moves in the markets, we were still seeing subtle improvement on the longer-term charts, NASDAQ 100, March 30th. Using this chart dated March 30th, we noted when this happened, above blue here, the financial crisis bear market was over. Cleared blue here, dot-com bust bear market was over. End of March, we cleared it. And remember we said, were we going to have problems for years? This is 1946, 1947, 1948, 1949. Or were we going to dig out much more quickly? When we compared this period to the present day at the time in March of 2023, objectively, using the trend strength model, this period on the left side of your screen was significantly weaker relative to March 30th, 2023. Shifting gears to April of 2023, we can begin to see why it's important to have a base case to manage against. The base case is not a prediction. It allows us to continually ask and answer, chart dated April 6. Does this align with or contradict the base case? The look of this chart is telling you that we should keep an open mind about the bear market being OVER. April 6th, similar, keep an open mind about better than expected outcomes look that we covered. All of these charts were taken directly from the folders used to create the videos during the year. We noted here, the only other time this happened was after the financial crisis bear market was over. The ratio slashing through a green cloud. April 6th, monthly momentum trying to turn up in a constructive manner above the zero line. How do you answer this question numerous times during the year, including in April? By taking a weight of the evidence approach. This is the look that we want to avoid. This is the look that we want to avoid. This was the chart dated April 13th. NASDAQ weekly constructive recapture of the zero line, trying to make a stand at an upward sloping 200 week. Secular bull markets tend to make a stand at or near an upward sloping 200-week moving average. If there's one chart that encapsulates the weight of the evidence approach used to answer this question numerous times during the year, this is it. In 2022, when the market was concerned about inflation, interest rates, and Fed policy, XLK, the S&P 500, technology sector, significantly underperformed 3 to 7 year Treasury bonds. Notice the discernible shift near the October low in the S&P 500. April 13th, this looks significantly better than anything in this window here, and it speaks to expectations related to this topic. In April, we have unquestionably improving charts in front of us, and yet on April 17th, it was reported that 95% of JP Morgan's investors think stocks fall for the rest of the year. And money managers were positioned extremely defensively. And yet, the economic data was getting less bad. April 20th, strong balance sheets told us, household balance sheets told us, to keep an open mind about the yield curve sending a false signal. As did the change in character, noticeable and discernible change in character on the chart of the VIX dated April 17th. Probably fair to say this chart dated April 20th has a noticeable and discernible shift relative to future economic expectations. Powell announces that it's time to retire the word transitory, ratio tanks. Market starts to look into the future in June of 2022, and I might add, this is the first wave of breath thrusts in this region here, and it wasn't just ITB that improved. The other major home construction ETF, XHB, improved considerably as well relative to 3 to 7 year treasuries. This is something that we can see, measure, and put in a model. This shift told us a lot about this topic and a lot about these topics. And in an April video using charts from the third week of April 2023, we showed a wide range of charts that were starting to lose their bear market looks. April 20th, semiconductors relative to 3 to 7 year treasuries above a now trying to turn back up or flatten out 250-day moving average. The relative trend in growth stocks trying to turn. Remember, best case scenario for margin of safety investors is that 2023 is a transition year away from a bear market and back to the secular bull market. April 20th. What does the chart on your screen say about the bullet points on the left side of the screen relative to the bullet points on the right side of the screen? October 2022, April 2023, the look after the major low, the look after the major low, the look here, April 21st, 2023. This recapture look for XLK, impressive in the face of Silicon Valley Bank. Headline dated March 10th, chart dated April 21st. April 28th, reminding us that from a margin of safety perspective, there was still work to do. The big news in May 2023 came from NVIDIA and provided evidence to support the concept of a productivity boom. And in May, we noted that in an environment marked by never-ending calls for a recession, and an environment where we still had legitimate concerns about Fed policy, interest rates, and inflation, we'd probably be better served focusing on the story being told by the charts, chart dated May 11th, as opposed to constantly worrying about something that may or may not happen. May 4th, S&P 1500 relative to 3 to 7 year treasuries reiterated that uncertainty was still a big part of the equation. We had improvement, but not significant and confident improvement relative to the bond market. Common sense told us that this chart dated May 4th, if really bad things were going to happen and we were going to move into major risk-off mode, that this chart, this ratio, most likely was going to break down. And it was possible walking forward from early May that may happen, and it may happen very, very soon, but it hadn't happened yet. May 11th, NASDAQ just now trying to complete step 3 of a probabilistic trend change. Break a downward sloping trend line, print a higher low relative to this low, and then print a higher high. May 12th, both charts telling us to be open to new and sustainable bullish trends. Covered this chart in May. It's dated May 18th. In 2016, 2017, early 2019, after the COVID low, when something like this happened, in those cases, the low was in the rearview mirror. May 18th, this looks discernibly different from this. This is what risk off looks like in Q1 2022. This is what May 18th looked like. Tweet dated May 7th, chart dated May 18th. Both helpful. May 18th, starting to distance ourselves from this look here and this concerning look here. For the first time, chart dated May 18th, we're starting to move into an area where you're feeling more confident that this is something more than a counter trend rally that's going to fail in a miserable manner. This looks discernibly different from this and the weekly chart on May 18th. But if really good things are going to happen, this chart, May 18th, still needs to improve. Noteworthy that the cloud has finally flipped from red to green. And even more progress here. When you cleared blue and red, bear market was over. When you cleared blue and red, bear market was over. May 18th, we're above blue and red. Observable evidence, helping us combat the issues on your screen. May 18th, QQQ divided by SPY, constructive turning up look in the all-important 250-day moving average. This looks significantly different relative to this look here in January of 2022. Anchored volume weighted average price lines telling us to keep an open mind about a new uptrend starting. Concepts also apply to the S&P 500 on May 19th and the S&P 1500 on May 19th. We covered this chart in a January video, and we covered it earlier in this video. Compare the look here on January 6th relative to the much improved look, can see, measure, and put in a model look on May 18th. Continued to ask this question in May, and this data set in May did not align with the imminent recession theory. And NVIDIA told us in no uncertain terms that AI was for real. XLK agreed, May 25th. All 6 of these charts on May 26th, constructive. Semiconductors possibly starting wave 3 on a weekly chart didn't align with these concepts. The data used to determine whether or not the U.S. economy is in a recession didn't support these concepts. Fan Principle, May 26, told us something looks different, discernibly different. Growth saying a lot about these topics and about these topics. Same can be said for triple Q related fear on May 25th. This improving look, this May 25th breakout, this May 25th relative breakout, and this mean reversion look on May 25th. Really not checking any bullish boxes back here in 2022, significantly different on May 25th, 2023. This is after a major low in 2016. This is May 25th. In June, a lot of bullish pieces started to fall in place, and risk-on charts were not difficult to find. Corporate bonds relative to treasuries not supporting the imminent end of the world theory. Same can be said for this ratio on June 2nd. The look of XLK at month end May 2023, covered in June 2023. June 2nd, 2023 monthly chart. This looks like a counter trend move within the context of an existing uptrend with the bullish cross taking place above the zero line. We wrote about this improving look in a Seeking Alpha article. and the concepts covered in this article proved to be helpful as well. June 2nd, constructive look, constructive look, constructive look, similar look. Told us to keep an open mind about the worst being in the rearview mirror. Noticeable and discernible improvement dated June 2nd. June 1st told us market breadth still needed to show us something. We really want the blue box on June 2nd to look more like the green box in the green box. Positive step on the weekly chart dated June 2nd. Same concepts apply here and apply to the new low in the VIX on June 2nd. This tight look here told us that June and July might be better than May and April. Q4 2007 really didn't look anything like 2023 on June 8th. The concepts of keeping an open mind and maintaining maximum flexibility were important in 2023 in this context. We entered the year clearly in downtrends. And with money markets paying over 4%, calls for an earnings recession rivaling 2008, and the belief by many that it's not a question of if we're going to go into a recession in 2023, it's simply a question of when. In that environment, it's not easy to make a decision to put capital in harm's way, and we want to make sure that we're doing so in a prudent manner. But with constructive looks on June 8th, unquestionable improvement, and the knowledge of what that improvement means within the context of history, the evidence in June, including the evidence outlined in this June 1st article, made it harder and harder to prudently stay on the sidelines. And the chart in front of you dated June 28th told us that the market was becoming less and less concerned about inflation and Fed policy. In this relative breakout, June 30th, tech sector relative to the S&P 500 told us it was possible this long-term window of indecisiveness and confusion was getting closer and closer to coming to an end. But we still had concerns about market breadth June 29th, Dow Jones Industrial Average. You can see the improvement on the S&P 500's daily chart at the end of June, and you can see the improvement in the monthly trend on the chart dated June 29th. As we move to the charts covered in the July 2023 videos, we want to continually ask and answer, do they tend to align with or contradict the theory of a triple economic boom? Chart on your screen looked constructive in May, wrote an article about it. It still looked constructive on June 8th. Global stocks unable to clear the anchored volume weighted average price lines here. Unable to do it here in Q1 2023. This looks discernibly different from anything that was associated with the bear market in 2022. Chart dated July 6th. Everything that we said about the previous chart applied to this chart of SPY. And at the end of June, we could see, measure, and put in a model this bullish cross. In looking at data going back to 1978, S&P 500 performance following similar bullish crosses, very impressive looking out 1 to 7 years. And even more impressive when we look at NASDAQ performance over the next 1 to 7 years historically. Once again, aligning with rather than contradicting the secular bull thesis. Chart dated July 5th, when we get a move from here to here, the bear market tends to be in the rearview mirror. Similar and constructive concepts. And the improvement on the NYSE's weekly cloud chart, looking at data going back 50 years, also told us to keep an open mind about much better than expected outcomes over the next 10 years. Average gain 5 years out, almost 70% in the S&P 500. Ran a similar study based on observable evidence on the NASDAQ weekly cloud chart. Average return in the NASDAQ after similar signals, 5 years out, approximately 80%. Observable evidence on the monthly chart of the Dow Jones Industrial Average also did not align with the imminent recession theory. Same can be said for this study based on the NASDAQ 100 and this observable A to B move that occurred in July of 2023. We nailed down a monthly momentum signal on the chart of the S&P 500 index. Historically, really good things tended to happen. S&P 1500 index weekly chart dated July 13th when we moved back to a full-bore bullish look. History told us to keep an open mind about better than expected outcomes looking out 3 years in the S&P 500 and 3 years in XLK, the technology sector ETF. The markets had moved a long way between mid-March and the end of July, and at some point we're going to have a give back, and that started in August. But as we noted here in this August 2nd post, the facts that we had in hand told us to be open to the market going on to print a higher high after any pullback or correction. This A to B move here was nailed down at the end of June, and if history is going to be any guide, it told us most likely that August high was going to be exceeded over the next 1 to 10 years. August 4th, rare stock signals say weakness should be followed by new highs, telling us to keep an open mind about favorable long-term opportunities. S&P 500 daily chart dated August 3rd, signal here, special K, historically. Something similar had only happened 12 previous times, looking at data going back to 1940. 3 years out, 100% of the cases the market was higher. The median gained 43%. There's a lot of talk in 2023, and there's still talk as we head into 2024 about an imminent debt crisis. And that absolutely, positively is something that we should respect as one of many possible outcomes. And if something like that is going to take place, it's not likely that a present-day chart would have this type of look, and it would eventually take on a much more concerning look. So if really bad things are going to happen, this is the type of look we want to avoid. This is the type of look we want to avoid. That is not the look that we had on August 8th, 2023. And since we know givebacks are 100% normal and to be expected, same can be said for sector rotation. Using this chart dated August 16th, we said it wouldn't be shocking if the S&P 500 moved down near these areas here. And during those type of pullbacks, we want to do everything that we can to make sure that we're not losing sight of the bigger picture. We know what a secular trend looks like. Secular trend from 1950 to the end of 1968 is shown on your screen, and it's discernibly different from this period of secular stagnation. And the same could be said for the 1982 to 2000 bull market. This is discernibly different relative to the period of secular stagnation between 2000 and 2012. And in that period, we had a bear market, the dot-com bust bear market, and the financial crisis bear market, telling us that if a debt crisis of epic proportions is around the corner, it's going to be reflected in the charts in front of us. So in mid-August, we asked, do we look more like this, or do we look more like this? So look in 2016, it's constructive. And if we examine the historical charts, the look on August 16th of 2023, constructive. We took it a step further later in August. If something like this, or this was going to happen, at some point your data is going to look very vulnerable. September 12th, 2008, market is vulnerable. From that point, the S&P 500 lost an additional 45.95%. Secular volatility model score, very low, very vulnerable, 10. Similar situation, June 13th, 2001. Vulnerable score of 20, additional loss approximately 38%. November 21st, 1969. Secular volatility model score of approximately 25, the additional loss almost 27%. March 27th, 1974. Model score below 15, a concerning below 15, additional loss from point A to point B, 35.52%. The median outcome in the cases that we just covered, an additional loss of 36.48%. The median score before that next leg down, 17.43%. And we compared that to the score on August 24th, which was a much more constructive 86%. The drawdowns continued in September with the bond vigilantes expressing their displeasure with U.S. deficits. But the longer-term charts were still saying there was an opportunity for patient investors. Constructive look at the end of August, August 30th. Nailed down at the end of August, typically good things happen. It was important to keep realistic expectations about shorter-term outcomes. Probably fair to say that this signal, the historical returns, aligned with the secular trend thesis. We also nailed down a positive long-term signal in the Dow Jones Industrial Average chart dated August 31st. We wrote about this ratio in June of 2023, and it still looked constructive on August 30th, 2023. Constructive look of the 200-day, 250-day, and 300-day moving average for the S&P 500, turning up on July 17th. Even more impressive on July 30th, 2023. If you compare this look here and this turn here to this chart, this bearish turn, this bullish turn, and this bullish turn, it's very difficult to say that we should be concerned about longer-term outcomes based on this look. August 30th, this is a very constructive look if you compare it to bearish periods and bullish periods. Does this align with a recession and a massive wave of debt defaults? The answer is no. Chart dated September 6th. Chart dated September 7th. Secular trends tend to make a stand at or near an upward sloping 200-week moving average. S&P 500 Growth ETF not really taking on a recessionary look September 7th, and discretionary trying to make a stand at or near an upward sloping 200-week moving average, similar to the major low after the COVID plunge. This, on September 7th, really didn't look anything like this during the financial crisis in 2008. September 13th, an observable shift. Chart in front of us, September 14th, really doesn't look anything like this, and it really doesn't look anything like this. How about the credit markets? September 21st, not nearly as concerning as this look here in 2022, and not even in the same league as this COVID fear spike. September 21st, answer to this question is no. Checking back in on this ratio, still looks constructive on September 21st. This is what maximum fear looks like during the COVID plunge. This is what September 21st looked like. How about the data used to determine whether or not the U.S. economy is in a recession? It clearly contradicted the imminent recession theory on September 22nd. As did the chart of initial jobless claims on September 16th. A lot of debate in 2023 relative to are we in a bull market or a secular bear market. In September, we compared the present day to bullish periods and to bearish periods, to bullish turns and bearish turns, and on September 21st, despite the recent weakness, it still sided and looked more like the bullish turns. And on September 21st, it really didn't look anything like this bearish turn during the dot-com bust bear market. While pullbacks are never fun, on Friday, September 29th, we were in this window here that we had previously talked about. Concerning? Yes. Overly alarming? No. Heading into October, the bond vigilantes were still in control, and there were still questions about the U.S. government being able to conduct future bond auctions in an efficient and reasonable manner from a refinancing perspective, which told us from a risk management perspective it was prudent for us to have a very good handle on areas of possible support for the major markets. Because if those areas held, There was really no damage on this chart here dated October 4th. There's nothing here that contradicts any of this, nor on this second chart that we covered in detail in an October video. And as noted in this October 10th short takes post, the VIX was not forecasting a debt crisis, recession, or bear market. And if we objectively looked at the S&P 500's weekly cloud chart between 1971 and 76, 1999 and 2003, 2007 and 2009, the look on October 11th was telling us to try to hang in there. The same can be said for all four charts on your screen here dated October 12th, the triple Qs, semiconductors, XLK, and the Vanguard Growth ETF. Here's the risk-off look for leveraged loans during the COVID plunge. This is the look on October 11th. And the look of J&K on October 11th, in this context, told us to try to hang in there. October 12th, the triple Qs still holding above this 61.8% retracement. Even though on October 12th in the stock market things were very unsettling, this discernible improvement on the chart of 1 to 3 year Treasury bonds told us to keep an open mind about a resolution to the upside. This is 15 calendar days before the S&P 500 bottoms. And this chart for the first time is taking on a full-bore bullish look on the weekly cloud. And that's the first time since the NASDAQ peaked in this area here in 2021. A similar try to do everything you can to be patient look relative to the slope of the 250-day moving average here, and considering that we were still in a situation where we had a multiple month base forming in SHY. SPY monthly cloud October 11th, another try to be patient within the context of prudent risk management chart. Same can be said for this XLK SPY ratio October 11th. This was the title slide from the October 20th video. Back in August, we talked about that it wouldn't be unreasonable if the market backtracked into this general area here. That's exactly what we had on October 20th. We'd taken out key area A, we were testing key area B, and getting uncomfortably close to key area C. And concerns would have increased significantly if we breached this area here for any significant length of time. Same can be said for the chart of SPY, dated October 20th. The larger chart is the broad S&P 1500. During the trading session on October 20th, we're down into this important gap up area here, so not shocking that we tested it, but it was a little unnerving that we came back here and tested it early in October, and we were back in the same general area 3 weeks later. On October 20th, with the VIX trading at approximately 21, we wanted to keep an eye on it, make sure that it really didn't breach this mid-20 level here, or more importantly, pop up into the 31 region. So at this point, it's not that difficult to choose the do-nothing alternative. This is October 20th again. Over the next 7 days, we started to move outside of the do-nothing alternative window. And as this 30-minute chart shows, the S&P 500 was incredibly weak between October 17th and October 27th. It really needed to show us something soon. We also had a concerning setup with the possibility of wave 3 down starting on the daily chart of the triple Qs, and we had just seen a qualified break of this TDST level telling us it's possible that the uptrend had flipped over into a downtrend. And on October 27th, our buddy Dean mentioned, so far the smart money remains uninterested in the almost 10% drawdown. The market needed to show us something. Really had not done anything on October 27th. The market was down on the 27th. About the only good thing that we could say on the 27th at the end of the week was that the market appeared to be making a stand at this important TDST level around 4104. And we still had some reference points reasonably close to price. And on the 27th, we did close below area C here, but we were still within striking distance. The longer below, the more concerning it would become. And this look that we see here tells us that the uptrend in 2023, it's on the ropes. And the S&P breached these levels on the 27th. SPY was able to hold them. So this and this gave us some room on the 27th to say, let's see what happens next week. Thus, on the positive side of the ledger on the 27th, we have this and this. But on the negative side of the ledger, we had a very concerning look the day before on the 26th on the chart of the S&P 1500. It lost money again on Friday. And this was also a concerning look at the close on October 27th, the NYSE Composite. So on the 26th and the 27th, the S&P 1500 breaches the anchored volume weighted average price line tied to the 2022 high and the 2022 low. Why is that concerning? Because that's very, very similar to the look here during the COVID crash. After breaching the anchored volume weighted average price line tied to the 2018 high and the 2018 low, the additional loss in the S&P 1500 was 24.54%, telling us, from a risk management perspective, probably not prudent to ignore this or ignore this. Again, this was the loss after a similar breach in the S&P 1500 during the COVID plunge. And in the case of the NYSE Composite, after this breach here, the additional loss was 31.57%. And this, conceptually, is very similar to this and very similar to this. So the question heading into the next week is this going to win? Is this going to win? Or is this going to hold? And is this going to hold? And when we see this, and we see this, and we know about this, and we know about this, and we know that it's not only these major cases where the market experienced gut-wrenching drawdowns, 10 cases on your screen here where the average drawdown was 53%, the median drawdown was 50%. Rare? Yes. Extremely abnormal and unprecedented? No. If we use the data on the left side of the screen here, dated December 26, 2023, so this month, we can estimate that money market funds during 2023 were paying approximately 4.62%. And if our goal during the year is to beat this number here, but to do it prudently and to do it without ignoring the charts in front of us, and to do it in a manner where you're acting as a fiduciary relative to retirement funds, this 5.46% loss on October 27th starting to look very risky relative to this number here. So given this, this, and this, in this historical context, and given that the S&P equal weight's down approximately 6%, the NYSE Composite's down over 3%, small caps are down almost 8% on October 27th. We did take some defensive action on Thursday, October 26th, still keeping the majority of our long positions intact, and we were ready to take additional measures if this level didn't hold on Friday the 27th. It did hold, and this level held as well. And in addition to this on the 27th, small caps, concerning look on the weekly cloud, not confidence inspiring. The same could be said on October 27th for what is looking like a failed breakout on the weekly chart, and small caps, the NYSE Composite, and this very concerning look on the weekly cloud chart of the S&P equal weight, all of that speaks to those concerns about market breadth, the sustainability of the gains in SPY, the S&P 500 index, and the Magnificent Seven. If these trends continued, then it was unlikely that SPY was going to continue to rise. And a big part of choosing the do-nothing alternative on Friday, October 27th, staying with our longs, it's based on the weight of the evidence. It's all of the charts that we just covered between January and October. The weight of the evidence that told us to keep an open mind about the longer-term trends remaining intact. While this look here, it's unquestionably concerning, but all of this is going on in an environment where the S&P 500, the NYSE Composite, the NASDAQ, and really all of the major US ETFs, equity ETFs, all of this is taking place with price above an upward sloping 200-week moving average, which factored heavily into the decision to choose the do-nothing alternative on Friday, October 27th. Probably fair to say that the decisions made on October 27th and in the days leading up to October 27th and the days immediately after October 27th were the most important relative to returns for full year 2023. The headlines on your screen, they range from January 2nd, 2023 to July 20th, 2023. And they do an excellent job summarizing the persistent and pessimistic sentiment that was in place for almost all of 2023. Started the year here, January 6th, clearly in a downtrend. High allocation to money markets. The bank failures in March only served to throw gasoline on the pessimistic fire. And when we're managing risk using a weight of the evidence and margin of safety approach, logically, it takes time for the evidence to improve. For example, the NASDAQ Composite Index doesn't complete step 3 of 3 for a probabilistic bullish trend change until mid-May. Step 1, break a downward sloping trend line. Step 2, print a higher low relative to the prior low. And step 3, print a higher high. Our goal is to prudently increase our exposure to risk as the evidence improves. And again, that takes time. But when you're in this window here, you're balancing the desire to participate in a new bull market with the desire not to get caught in a counter trend rally that's followed by significantly lower lows. And given as of the close on October 27th, the S&P 500 standard weight capitalization weighted index was up only 7.2%. Equal weight was down roughly 6%. NYSE Composite over 3%. Small caps down approximately 8%. Given everything that happens between point A, point B, and point C being December 28th, we're very pleased with our full year return as of the close on Thursday, December 28th. We prudently increased our exposure to risk as the evidence improved, and we significantly outperformed the money market. Now, thankfully, for those of us that were bullish during 2023, Friday, October 27th was the worst day of the year. Everything improved walking forward, and for the most part, support held. We covered this data all year long, and on November 2nd, it still didn't support the imminent recession case, and it really didn't support the severity of the decline in October. Credit spreads also made a stand near a logical level at the end of October, and the VIX never reached levels that we discussed in this October 10th post, a post that told us to try to be patient, and by November 2nd, the VIX was back down to 1616, well below this median level of 31. This is the NASDAQ on October 27th, testing an incredibly important area. This area here is tied to the COVID high, the COVID low, the 2021 high, and the 2022 low. If this holds, it says a lot about expectations relative to future market and economic outcomes. And if this doesn't hold, it questions this entire rally and it questions this entire rally. So thankfully, when we got to November 2nd, we bounced right at that extremely important area. The same can be said for SPY, October 27th on the left, November 2nd on the right. Same can be said for the broad S&P 1500, bouncing at an incredibly important level, tied to the 2021 high, the 2022 low. RSP, much more concerning look on the 27th. We were well below the anchored volume weighted average price line tied to the 2021 high and below the anchored volume weighted average price line tied to the 2022 low. So this is an overshoot. And thankfully, secular bull markets have a tendency to make a stand at or near an upward sloping 200 week, which is exactly what happened with RSP after this overshoot. So on the 2nd, at least it's moving in the right direction. The worst overshoot? Small caps, below the 200-week moving average and below all of these important anchored volume weighted average price lines. We did make a stand here near the 2022 lows, and at least we're moving in the right direction again on November 2nd. JNK, the 27th, getting down to an extremely concerning level, but it reversed sharply, and that's a good sign for the bullish case on November 2nd. And on the 26th, we were right near that tipping point, right on the cusp of that 55 to 45 range, the secular volatility model. And again, thankfully, scores were much improved on November 2nd, back up to 78%. Still had a constructive long-term look on November 2nd. And like this secular trend window and this secular trend window, back in 2022, the S&P 500 made a stand at or near an upward sloping 200-week in blue and held above it during the drawdown in 2023 that ended on October 27th. Thus, the look of the long-term charts in late October and in early November continued to align with a demographically induced secular bull market that was set up for possible productivity enhancements in the coming years based on advancements in technology. And the big news in December, a discernible shift in the Fed's tone. And it's possible that we've come full circle from when Powell ditched the transitory tag here to the market's expectations about Fed policy, interest rates, and inflation on November 30th here. Make an argument that this look here and this breakout here is anticipating the Fed shift that's about to come. The end of November, the look for short-term corporate bonds, significantly different and significantly improved relative to anything that we saw here in this window. Early 2022, the bear market year, significantly different in late 2023. Chart dated November 30th speaks for itself. 10-year yield at the end of November calming down near a logical region. December 1st maintaining that risk-on bias. Been waiting a long time for this. We had it on November 30th. And we went extremely rapidly from the entire rally off of the 2022 low and the entire rally off the COVID low being on the ropes right here on October 27th to a both rallies are alive and well look on November 29th. A much improved look on the weekly cloud chart. A much improved look on the monthly cloud chart, November 30th. Another chart that helped us during the recent correction, told us to keep an open mind about better than expected longer term outcomes. It's dated November 30th. This is what a bullish trend looks like. This is what a bearish trend looks like. This is what November 30th looks like. These are bear market looks. These are the looks after the bear market's over, 1975, 2003, and 2010. And this is the very constructive and similar look on November 24th, 2023. And after a painful correction and a lot of uncertainty in late October, eventually what we wrote about on August 3rd, the longer-term charts came through, and the market in December exceeded the high from late July, early August. And in recent weeks, we are finally seeing some improvement in market breadth. Here's the look on November 9th. This is the improved look on December 13th. Very similar to the look of JNK high-yield bonds. When you're down here, the entire rally off the COVID low is in question, and the entire rally off the October 2022 low for the S&P 500 is in question and being tested. And the sharp reversal in the look of the chart on December 12th says thus far, we've passed. Secular bull markets tend to make a stand at or near an upward sloping 200-week moving average. The 200-week is shown in red. This is the broad Dow Jones Composite average as of December 12th. This is the look on December 14th. We covered it earlier in the video. This is the look of the exact same chart on November 1st. Market-friendly headlines from December 13th. and charts in front of us in December, this one dated December 12th, that align with rather than contradict the secular bull market thesis. And as we covered last week, another confirmation signal came on December 21st. Subsequent S&P 500 performance, NASDAQ performance, and NASDAQ 100 performance tells us that something that just happened in December of 2023 aligns with, rather than contradicts, the thesis of a demographically induced secular bull market that could be further fueled by a multi-year productivity boom. 2023 appears to be a successful transition year, which means we have a resumption of the secular bull market, a primary trend that could last until 2035. Unlike 2023, where the NASDAQ is just a few calendar days removed from its final bear market low, we enter 2024 under much better circumstances. If you've watched these videos for a long time, you've probably heard us say at one point that even though the stock market bottomed in October of 2002, the bull market in that case really didn't start until the spring of 2003, March of 2003, and that was after a retest. That's where the weight of the evidence really started to improve and the bullish trends were easily seen and clearly defined. It's very possible that in future videos we'll be saying the bull market really began in October of 2023, when market breadth started to improve and participation became much healthier. Regardless of all the green tables in this week's video, it's incredibly important that we head into 2024 with realistic expectations about how markets operate in the real world. And we all know the only way that we're going to be able to leverage the triple economic boom effectively is we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.